Hi, everyone. This is the week ahead. I'm Tony Nash. Today, we're joined by Michael Belkin and Tracy Shuchart. We're talking about yields, stagflation, and emerging markets. Michael's got some great parts of his current newsletter talking about that. He also talks about energy and geopolitical risks. So he has a really interesting perspective on it. Tracy, obviously, we always talk about this, so it's going to be a really interesting section where they both come together on that. And then we're going to talk about LNG. Tracy had some really interesting posts about LNG over the past week, so I want to dig into that. So Michael, thank you so much for coming back. We love having you on. And I don't know if you know this, but we actually talk about you after the show. So we enjoy the time with you here because you bring just such a great perspective, just a very data-driven perspective on markets, which is fantastic. So thanks for coming.
My pleasure.
So I want to start talking about yields and treasuries. So treasury yields have risen sharply, as we've seen. Your latest newsletter says that you've closed out all of your treasury positions. So can you talk a little bit about the treasury market? Do you see this as a temporary spike or the beginning of a longer trend in the bond market? Where do you see this contextually?
Okay, just to review what I do. So my approach is forecasting. I developed a forecasting model based on my studies at UC Berkeley Business School, applied them at Salomon Brothers, developed the model further. And so it's a different discipline than you see out there. I actually had one of my clients is a big hedge fund in the San Francisco Bay Area, and one of their interns just is a student at UC Berkeley, and I had to go over my training with her. And I went back and I saw that they don't teach time series analysis. That's what I do in business school. So there's a lot more books on it now than there was
It's
back
so
in the day.
weird, right? That's what we do day in, day out. That's what you do day in, day out. How do they not teach time series analysis? It's just weird.
I don't know. But anyway, so I kind of fed her a bunch of I did research. Now there are a lot more books on the subject now. If you Google time series analysis and financial markets, there are books about it, but it's not something that's widely followed. Anyways, long story short, that's what I do. So I'm looking for inflection points, and the model basically likes to buy low and sell high. And so I've been long bonds for quite a while, and most of the model forecast for economic stuff had turned down a while back, and bonds were a great long. Not just U.S. bonds, treasuries, also European bonds, bunds, gilts, Canadian bonds, Australian bonds. Basically, bonds around the world were a great trade for about the last 3 to 6 months. Economy slowing down, bonds rally. So anyways, that's over. So there was a sharp reversal a week or two ago, and I'm out. What I do is direction, position, and intensity. That's what the model does in a 12-period forward forecast. In the weekly view, that's 3 months, it's looking grim. So bond prices down, yields up, but the long term is still down for yields. So I don't want to be too flaky here, hemming and hawing, but this is probably a correction. I think bonds will come back into a buy, but you just don't want to be long bonds right now. And of course, what contributed to that was the change in stimulus in China. So all of a sudden, China was in the doldrums, and then they're throwing all this gajillions of dollars at everything. And that ignited, so basic resource stocks, iron ore, base metals, all these kind of things that were down on China woes, all of a sudden started rallying, and that kind of killed bonds. So also, one other thing is the Citi Economic Surprise Index had been very weak for a long time, and all of a sudden, about a month or so ago, it started coming back. So the news has been stronger. The economic news has been beating expectations. And again, today, so we saw CPI, right? CPI beat, it was higher than people were looking for. Annualized CPI is now 2.4%, core at 3.3. That's kind of throwing casting aspersions on the Fed's idea of all these, major rate cuts coming for the rest of the year. So that was built into the forward rates. I've been long SOFR, which is the euro dollar replacement, all these things. Been a great trade. Those are all closed out. So I'm just kind of standing aside. I think there'll be a correction. I think my longer term view is the economy is weak, but we're doing something else at the moment. So anyway, standing aside from bonds and also the dollar, that's a major thing that the dollar had been a great short for the last few months. I've been short the dollar, short dollar, long euro, all these currencies. Japanese yen had a huge rally. That's out. So there was a reversal there in macro stuff. And so that's the answer to your question on bonds.
That's a great perspective. What what do you think that does for the Fed's trajectory? You mentioned that just a little bit. Do you think the economy is pulling up a little bit now, or what do you think is happening there? And we hear people say maybe two Fed cuts by the end of the year. I'm not sure if you're comfortable talking about the number of Fed cuts, but do you think the Fed will move as aggressively as people had been assuming, say, last week?
No, so I think they follow what happens in the forward rate markets, right? So the forward rate markets kind of lead the Fed at this point. I mean, we're in this crazy system where the central bank sets interest rates like some Soviet Union Politburo.
Yep.
It's crazy, but that's what we have. You have to live with it. And I watch I watch Powell's press conferences and the questions very closely afterwards. And it just kind of cracks me up because he says, well, we're dealing with all the data and we're data dependent. I mean, the
Sure.
free market could decide this much more clearly than a bunch of panel of these guys sitting around,
Right.
looking at.
600 PhD level economists or whatever.
Yeah, I mean, short rates should float around. Like, why set them at any rate, So we got into this, and previously, before Greenspan, we weren't on a setting interest rates Fed policy. It was reserve targeting. So since Greenspan, which is like 87, since 1987, so what's that, like 30, 50 something years, we've been on this, the government sets interest, or the Fed sets interest rates. So anyways, but the forward market kind of guides the Fed. So they have to do with the forward, if the forward market kind of leads and says, so the forward market's been tightening. So all those, I think the forward market and these latest inflation numbers are going to make it more difficult for the Fed to add, to cut rates. And another weird thing is they're still doing quantitative tightening. Like, how do you make this stuff up? So they added all this money during the, COVID. They did, quantitative easing up the wazoo. We had trillions of dollars of money. And now they're quantitative tightening, which means selling things from their balance sheet, bonds, or not selling them, but letting them run off and not reinvesting the proceeds, mortgage backs and treasuries. So, usually that happens when the Fed is tightening. So they're still tightening in quantitative terms, but easing in interest rate terms, and nobody at all those people, all those journalists in the Fed's Powell's conference, nobody asked him about that. Like, what the heck are you doing?
Of course they don't, because if they ask a hard question, they won't be called on anymore. So
Yeah, you get kicked out.
That's exactly true. You won't get asked. You don't get asked back to the meetings. This is
yeah,
the
it's
fact.
like going to the PBOC or the old Soviet central bank. Like, you can't ask a wrong question or they won't call on you. So this is the state of financial journalism, unfortunately, or economic journalism. So it is weird, and we've talked about this several times, how the Fed is tightening with one hand but easing with the other. Do you think why do you think they're doing that? Do you think they look at, say, their balance sheet and the money supply, and they're just like, okay, it's too much. We need to take these kind of high scale or high level mechanisms and tighten with those high level mechanisms, but in a precise way, we're going to control interest rates for the short term. Do you think they're seeing those on different timescales?
Yeah, I guess it gets back to how much stimulus they added, and it was just unprecedented. I mean, just ridiculous, and money supply growth up double-digit percent, and huge expansion in the money supply from all this credit they added. And it gets back to bank reserves. So bank reserves are still high, and that's stimulative. So I think they feel, on the one hand, they think the cost of money is too high, but the quantity of money is still easy in terms of bank reserves. So don't ask me. It's the messed up system that they created and they follow.
fundamental misunderstanding of economics, supply demand, that sort of thing. It's just weird. It's very weird.
Oh, one interesting thing. So, Al, one question that did get past the censorship block, was they asked him about employment report, and and he had said in July, well, the employment report is so strong, so strong, so strong, so strong. We can't cut rates. No. And then afterward, then they cut rates by 50 basis points. And then somebody asked him, well, what about the revisions? So there were these huge revisions in the employment report. Basically, 30% of the jobs supposedly created were wiped away with a magic wand, and nobody pays attention. So the idea here is, without getting too conspiratorial, we got an election coming up, and the Labor Department wants to put the best spin on everything. So if you lower the, last month's number, and then you announce this month's number higher than it should be, it looks great month to month. And nobody pays attention to the fact that the last months were much worse than what was originally reported. So it's this mental mind game, but he said, Powell said, yeah, well, if we had known that the jobs report were artificially high, I love that quote. That was his words, artificially high, then yeah, we probably would have cut in July. So we're in this weird, hall of mirrors where the government's putting out these weird numbers, the Federal Reserve's responding to them, and then they get revised. It's just a very strange system we have.
Well, I think we know one thing for a fact: nobody at BLS will lose a job for being terrible at their job. Never happen, right? So whether it's conspiratorial or not, we're still going to get more of the same. And I think markets will bake that in. People will start to expect that the employment report is inflated by 30%, and they'll just discount it over time. So
will they? But
that's really interesting. I think there is the immediate algo trading that happens, and then there's the 5 to 10 to 15 to an hour after the number is announced, where real people come in. And I think those real people will discount it, but I think the algos, unless they've been adjusted, and algos are kind of expectations of expectations of expectations. So they're trading on what they think people are going to do, and it's a mess on the immediate kind
it
of
is a mess.
comes with
And nobody cares about those revisions. I mean, we've gone over these a million times, and it gets me irritated every time we have to talk about it because of so many reasons.
Well, you get in a second,
not to
and you
mention
make
all
your
the
money.
revisions, and nobody cares about the revisions. I posted something today that said, because of the adjustments on, how they're doing September numbers now, really it should be 100,000 jobs lower than, it was. It's just, the 254,000 or whatever it was in September due to the way that they're calculating it right now. I mean, it's just like, what's that quote? Something like, if you beat data enough, you can beat it into submission, or there's some
again,
quote like that.
Yeah, that goes back to the people of BLS will keep doing what they're doing. And Michael Green has been on this for years, talking about the statistical issues with jobs data. And so, I think over time, people and the algos will get used to it not being real or discounting it or whatever, because those algos learn over time. So, but there's no incentive for them to do it right now, because it's an expectation of an expectation. And, just what you said, Tracy, well, just nobody cares what the revision is. So over time, people will care. Michael, you mentioned China, and in your current newsletter, you said you are short in all emerging and frontier markets. You say that contributes to a stagflationary environment for now. So can you explain how those two are linked?
Yeah. So first of all, a view on emerging markets. So EM ex China, which is Latin America, Eastern Europe, Asia, and those have been on a real tear, particularly places like India and some markets that people don't really look much at, like Turkey, Poland, Hungary, Czechia, Greece. That's in the emerging market universe. Those are like, they went parabolic for like no reason while China was going down. So I think it's just kind of a money flow sort of thing. Anyways, huge bubble in EM ex China. And I've been saying that for months. And they went up a little bit more. I had some egg on my face over that. Then all of a sudden they reversed very sharply last week. So Turkey, Poland, Greece down 5-6%. India, which was the star, that was the poster boy for you got to be in India, blah, blah, blah. It's new China. No. Anyways, bubble. So big bubble waiting to burst. And, so it gets back to where the big bubble in everything, right? So, I mean, things that are up a lot, that are overowned, are waiting for some kind of a shock, some kind of a psychological shock to change things. And so this gets back to the reversal in energy. So I, as well as doing the time series analysis, I am an investment strategist. So investment strategists have put what are the pieces of the puzzle, say, based on I've been doing this for 30, 40 years now. What is going on out there in the real world fundamentally? So we've been this war, we've got these wars all over the place right now. So the Houthis and the Red Sea and Israel and Gaza, now Israel and Hezbollah, and Israel and Iran and Ukraine and so far the market's just kind of shrugged. So what? So what? It's great.
Right, exactly.
Great,
Except gold.
Gold.
Gold is where where geopolitical risk hides right now, right?
Right. So the reversal in oil, I think, is a big deal. So all of a sudden so fundamentally what happened is Israel sent all these missiles. Iran sent all these missiles into Israel. A few got through, most got shot down. Now it's Israel's turn to respond. And what are they going to do? So, by the way, a great read every day is the Times of Israel. If you want to know what's going on, it's not real biased. It updates kind of like the Drudge Report just to see the headlines. I think it's really good factuals. I recommend everybody look at that because it has inside read on what the Israelis are thinking, and they leak things from the military, and you can see. So basically, I think we're setting up. So the Israelis have said we're either going to attack their oil fields or their nuke plants, right? And if this, who knows? I don't know exactly what's going to happen. Nobody does. But if it's already happening. Like if you read Times of Israel now, there's all these terror attacks in Israel all of a sudden, just in the last few weeks. So they've been immune from retribution, but all of a sudden it's coming back. So now they're going to do something against Iran. It's retaliation, tit for tat. They wait a few weeks, and then it's Iran's turn again, right? And Iran has said they're going to attack, and they said if any of the Arab states, Saudi Arabia, UAE, Iraq, any of these places allow the Israelis to fly over in their airspace to attack Iran, then they're considered their enemy. So all of a sudden we've got the stakes are high in the Persian Gulf, where the Persian Gulf and energy prices could finally all of a sudden, and they've been creeping up. We've reversed over the last few weeks, but this could really go. This could really be big, potentially. We don't know for sure. I'm not. I don't have a crystal ball to know exactly what's going to happen. And the U.S. administration is doing everything it can to prevent that before the election. But anyways, that changes everything. So that makes energy. We'll get into that in a second. But it basically pulls the rug out of a lot of this other bubbles that were out there. So you asked about stagflation. So all of a sudden, these EM markets that were bubbles, all of a sudden turning down. The oil price turning up. It's good for the dollar. The dollar has reversed, on a flight to safety, basically. So and all of a sudden the economic stuff is a little bit stronger, looking a little bit stronger in the U.S. And the bonds are selling off. So there's a complexion change, probably not permanently, but at least for the next few months, where the things that were dictating what happened in financial markets, on a macro level, have all of a sudden reversed.
Okay. And so the stagflation part of it, so are you expecting jobs in the US to continue to sour?
Okay, so today, interesting, good question. So the IUC initial unemployment claims were up sharply today. Hurricanes. So we've had 2 hurricanes. All of a sudden, people are losing their jobs, and they can't like wipe that away with a magic wand before the election. So that's happening on one level. I think the longer term for the economy is negative, but I think we've got this sort of intermediate term for me is 2 to 3 months where they've thrown whatever they can, the administration to make everything look great before the election. And it's actually working on some level in terms of, things like the city economic surprise index and things like that. And it's working on some level, but I don't think it's going to work long term. So I guess what I'm saying is it's a head fake, probably, but it's something that you can't resist for the next few months.
I keep hearing from very smart people that 2025 is going to be more difficult than we all want to admit. And it sounds like you're saying that.
Well, yeah. So let's talk about the stock market. That's not, so the NASDAQ peaked and a lot of global markets peaked on July 10th.
Ooh,
they're not
hold
down
on.
much.
Let me ask you my tech question because that'll get right into this. Okay. So that's a great point. So, there is a huge amount of enthusiasm for tech still, right? And so your model indicates that it's a sector to short. So what's happening? Because I have the NASDAQ with the 200-day moving average chart from your newsletter. So what are the key indicators you're watching for tech, especially with AI-related firms and stuff? Like, do you think these are overbought and due for a correction? So let's get into that NASDAQ discussion that you started.
Okay. So, first of all, July 10th, here we are, October 10th. That is 3 months ago. 3 months? Hello? Like usually tops are like some kind of spike thing and they sell off, have a couple bounces. But this has been relentless. Like people, there are really believers, like whoever they are, they, quote unquote, people, every morning, there's a huge buy program in the S&P. If you look at tick, and the algos, ramp up the futures to accommodate the buyers and then sell off a little bit. But it's not just the NASDAQ. So yeah, the S&P hit a new high, but that's driven by defensive sectors. So there was this big rotation shift starting months and months ago, right? And so the tech sector, XLK divided by S&P. So a lot of what I do is a lot of my clients are hedge funds and long-only portfolio managers who need help with sector rotation. So that's what I do. Sector rotation. Tech has underperformed massively by 6-7% here in the US. If you look at the ratio, it's below the 200-day average. It's right, kind of bounced back up to it. But so XLK divided by S&P ratio. And do you see that anywhere? Do you see that reported on Bloomberg? Do you see that reported on CNBC, Financial Times, Wall Street Journal? No, it's like it's going up. People are oblivious. They're not looking at what I'm looking at. So basically, but I tell you, if you're like a tech portfolio manager, you're feeling it. So I can't wait to see these second quarter numbers, third quarter numbers on, tech funds. They're not going to be terrible, but they're not going to be great because a lot of these stocks underperformed massively. So they keep buying NVIDIA, the poster child. They keep buying it. It's almost back to its highs. But a lot of these other stocks are down. The software stocks are down massively. You asked about AI. So let me give you another thing I do is press clips. So that's part of the Belkin report every week. Belkin report's a weekly publication for hedge funds and institutional investment managers. I just had a great story this morning from Ars Technica. The more sophisticated, which is not a boom, that's not a bear publication, right? This is just tech publication. The more sophisticated AI models get, the more likely they are to lie. This is great. You got to read this article. We're a research team led by a medical educator, blah, blah, blah. One of the things surprising was AI's propensity to give well-structured, eloquent, but blatantly wrong answers. And the article goes on and on about it. So basically, they train these things on all this data, and the models need to prove that they're experts. So they make these blatant assertions that are completely wrong when you dig into it.
So running an AI company, the conclusion I take from that is that the experts that they're borrowing from are actually lying.
Yes,
So
absolutely.
the AI is only repeating what it sees in the literature. So if anything, that should circle back on itself and force us to question the kind of experts, right? Who are the most highly published or most frequently published experts that the AI is borrowing from? Because the AI is simply a statistical engine. That's all it's doing, right?
Right.
And so it's perpetuating lies that experts have told, that now people are going back to say the AI is lying when in fact the experts are lying, which is fine, right? I mean, that's human nature.
Well, like it or not, that was kind of one, like him or not, I should say, that was one of Elon's kind of major concerns, is that this could be turned into a weaponized tool based on the information that's out there, whether that's right or wrong. And so we have to be very careful, and we need to monitor this sort of technology. And again, like him or not, I think he's absolutely dead on this point.
Yep. I think you're right. I think, and I guess a question for both of you guys. I use AI all through my day, whether they're LLMs or whether it's time series forecasting approaches or whatever. And I think it's incredibly useful, but I think that most people don't use it very much. So just because, and let me act like I'm you for a second, Michael. Just because you are saying that technology and AI is overhyped for now, you're not implying that it's not useful. You're just saying that it's overvalued at the moment. Is that fair to say?
Yeah, also it's biased. So basically what you said is it's wrong because the experts are training it wrong. So AI is obviously training and then inference. And the training part is where they use these NVIDIA things and they go through Wikipedia and everything that's on the web forever, and then they come up and then they're trained by these so-called experts. So that's obviously biased. So something's wrong there. They're just like injecting their own bias into what. So that article I told you about in Ars Technica, they specifically quote Chat GPT, where it's just wrong, and it's the most wrong of all of them. But also the other aspect of this is, so this training obviously absorbs huge amounts of resources. So that's the whole thing. Buy NVIDIA because they make the processors and. So if there's one thing I've learned from the markets over the years is that shortages turn into gluts. Okay. So right now, the video is going around, and the demand is so insane. We're building new factories in Mexico, and we're going to process it.
Right.
So I mean, just wait. So the free market, that's how free markets work, right? Somebody's making too much money doing something or a lot of money. The competitors come in, or the orders. So some combination of AI, the orders get cut back, or somebody else comes up with a processor competing, a processor or something, and the orders start going to that. So basically, NVIDIA, I think, is, John Templeton said the time to sell is at the point of maximum optimism. Time to buy is at the point of maximum pessimism. We're like way beyond the point of maximum optimism in AI. So yeah, I do think I don't personally use it a lot because I don't have my own models, and I can't depend on these ones that are out there. They just give me ridiculous answers that don't pan out. So personally, I don't think it's there yet. I think it will be at some point down the road, but it's just like the top in the tech bubble in 2000, where the internet looked like great and all these stocks went down 90% or 100% went bust, and then the winners emerged, decade later or something. So I think it's kind of some sort of idea like that, where it will take a long time to sort out the winners from the losers. Right now, we're at the point of maximum optimism, and it's going to look a lot different in a few years than it does now.
Sure. Yeah, I think you're right. Go ahead, Tracy.
And I think as with anything, if you hold a monopoly on anything, and whether that be a chip or a drug or whatever, that only lasts for so long before the competition starts to catch up with you. And so then you have a lot more choices and things of that nature. And so you're not the only game in the town.
Yep. Yeah, like I said, I think these companies are amazing. I think the stuff they're doing is amazing, but I think the market hasn't caught up with the capabilities yet. And also, as you say, Michael, I think the capabilities obviously need to be refined. So we're not going to get to the point where people completely trust it until there's more refining there. And it's just going to take time. In the meantime, I was sitting with somebody last week who's an expert in this space, and where we came to is there will be segmentation in these AI chipsets. So NVIDIA isn't the only one. They won't be the only one. There are going to be segments of lower capability, lower quality, medium quality, all that kind of stuff. And
That's what I just said.
yeah, I know. And when that happens, we're going to see all that stuff settle. It's going to take a while. And if you look at the AMD announcements over the past several months, I think they're really trying to go for that middle spot. They don't want to say it. They're acting like they're going to compete directly with NVIDIA. But I think they're really going for that mid-market placement. So, but I think you're
They
right.
just dropped 2%, by the way.
AMD did.
AMD.
Yeah, well, their
just now.
CEO came out and said some stuff that they don't have the capability to do yesterday. So it's just silly when CEOs do that. So let's move from tech. I want to move back to energy for just a minute. And you talked about things escalating in the Middle East, Michael. And I've got your energy sector to S&P 500 ratio, 2000 to now on screen. So is this an opportunity right now? Your forecast says yes. Why is this an opportunity? Is it on the risk? I mean, I'm not sure that the risk necessarily implies an opportunity. Is it lower supply? Why is the opportunity there in energy right now?
Okay, I think so. First of all, there are two things: time series analysis, direction intensity, up early, just starting. It's been a huge underperforming, so that's the model says yes, and then the investment strategist hat says potential for oil price shock. And if I was lucky enough to be invited to this Vail Investment Forum, in January, and there were a lot of energy experts there, and also economists and stuff. And one of the consensus things that came out of was that the economy, before a recession, it's vulnerable to a shock. So basically, when the business cycle is old and ailing, it kind of starts to roll over, and then frequently, not always, there is some kind of a shock that sends things spiraling down into a recession. So that's basically what I think. We have the potential for an energy price shock based on. So 20% of the world's oil goes through the Strait of Hormuz, right? And if Israel starts knocking out Iran, Iran's going to do something, and who knows what it's going to be. And the U.S. will, who knows? This could get really ugly. So we've got aircraft carriers, and who knows? But all of a sudden, it's going to, there could be a serious disruption in energy supplies to the rest of the world, and that could affect things in a big way, and it could provide a big psychological shock to bubble people in the U.S. who have been buying the market nonstop, assuming that trees only grow to the sky.
Sure.
And so, yeah, I have a strong recommendation. This is the time to buy energy stocks. Back to John Templeton, buy at the point of maximum pessimism. Stocks out of favor, 3% weighting in the S&P. So nobody even cares about it. Passive investment funds, hedge funds, 3%, who cares? I like tech,
Right.
Blah, blah, blah. So if you want a total contrary, trade that's totally out of consensus, nobody cares about it. Passive doesn't cares about it. They're probably, it's been going down for a long time, underperformed massively, potential for ups. Yeah, so that's my number one, I would say, fresh. The model likes to get in the ground floor, point A to point B, point A being a turnaround point at the bottom. I think we're, barely going into the first inning in a major outperformance of energy shares, and also absolute terms going up.
Tracy was telling us, I think it was a couple of weeks ago, where energy used to be 20 or 30% of the S&P, and now it's 3%.
20%, yeah.
20%. That's just incredible. So, Tracy, let's get a little bit tangible on this. So, how do you anticipate the tensions right now? Michael talks about kind of uptick in prices, a surge in prices. So how do you expect not just the crude prices, but energy equities, let's say maybe before the end of the year? Do you think there's an impact there? And also, let's also, since Iran is such a part of the discussion, you put up a post on Iran crude loadings, 2023 versus 2024, and they look way down on that. So
No, it's not 2023 versus 2024.
okay,
Let me dig into this.
yep, please
Go
do.
on with your question, and then I'll dig into this.
Yeah, I'm just wondering, how does that look? How do those crude loadings impact the price action in the short term, but also the ability? Well, and who is filling that gap? Is Russia filling that gap or something?
Okay.
How does that impact the equities?
All right.
Those companies.
Let me just start with the Iranian crude oil loadings is very new within the last couple of weeks. So it's not over a year. In fact, from 2020 to 2024, US has kind of looked a blind eye, and their oil imports or exports, sorry, increased from 500,000 barrels per day to 1.7 million barrels a day. And so the chart I posted is literally like brand new. It's not a yearly chart. It is because of what just happened. So once kind of this conflict escalated between Israel and Iran, what happened is Israel kind of, after Iran attacked Israel, Israel said, well, we might attack your nuclear facilities, or we might attack Karg Island, which is their major export facility and holding for an oil holding. And so what happened is they cleared all their ships from that area, and they didn't load anything. And so that's why we have seen, because this is just new, literally over the last couple of weeks, that we are seeing this happening. So again, if that chart looks deceiving to you, this is literally what's just been happening over the last couple of weeks. We're seeing that those exports down because they moved their ships. They're not moving anything in or out of Karg right now because they're massively afraid that something may or may not happen. So that's what's going on with Karg right now. Now, as far as oil is concerned, as a whole, and looking at that, Michael's much more bigger cyclical than I am. So, I'm just looking kind of more in the immediate term when we're talking about oil. I do have my macro views on that, and I 100% agree with Michael on his macro views. But if we're just looking, what we've seen in the oil markets is we saw this massive pessimism as far as CFTC, COT, that's positioning in the futures markets, meaning the paper barrel market became so disconnected from the fundamental market because nobody wanted to be long this thing. Everybody hated this thing. We saw the largest short in the market, even beyond 2020, when we saw oil prices go to negative $37, positioning became so short. And so once we had some sort of actual initial threat, that kind of became a short squeeze, right? And I had been posting, over, we're going to see if we get back above, $72, $73, we're going to see a short squeeze. And we did. We hit almost 78 or 78.46. Then we saw, back off because we thought that Israel may not attack Iran, right? Because there was enough time that lapsed. They were attacking Lebanon. Everybody thought, okay, this is going to be fine. We're all good. Now, that all changed overnight when Netanyahu had a phone conversation with the Biden and the Biden administration. They tried to convince him not to do anything with Iran. And he basically turned around and said, we're going to attack them. We're going to have a meeting at Thursday night and decide how and when we are going to attack them. That was reported by Bloomberg. And then we just saw a report from Sky Arabia that said the Israeli Congress approved the attack plans from the government. And we're seeing obviously crude up over 3% today.
So when you say overnight conversations with the Biden administration, do you really mean 3:30 p.m. Eastern?
Well, I mean, the article was published at about 6:30 a.m. that said they had a conversation with, and then said that they were going to, Israel was going to have a conversation. So, I don't know if Biden was actually on the phone call himself, but his people were, let's just put it that way. So somebody is up in the White House having conversations.
Right. Thank you for indulging me. I appreciate that.
With the Netanyahu administration, let's just put it that way. So anyway, this kind of, and that all kind of went under the radar a little bit, until then Sky Arabia, everybody just posted the Sky Arabia thing just a few minutes ago, and then oil shot up about another buck over that one. So we'll see, but
like
I think
4% today or something.
Markets have been 3.18%. Markets have been a little too complacent as far as oil is concerned, and that's why I think suddenly we're starting to see. Well, obviously, it's going to be a big deal if Iranian oil installations, whether that be production or carg. I think they would probably target carg. Just because they have a lot of oil stored there, that's their oil storage. It would be a little bit harder to attack oil installations. However, that said, their oil installations are pretty concentrated in a few areas. So that really depends. The problem is they share a lot of oil fields with Iraq. And so that brings in a whole another problem if you don't want to bring Iraq into this situation. So again, that's why I think carg probably would be the target over oil installations. But it's a pretty tenuous thing right now. Now, I just do want to add that this can be counteracted by I want to remind everybody that OPEC still has spare capacity and voluntary cuts, so you can replace Iranian oil, say it gets completely taken off the market. Now that can be replaced by OPEC. The problem is it's going to take time. And so you're definitely going to have an initial market reaction. It'll probably take several months for OPEC to ramp up and replace that product. So it's not like it's gone forever. I mean, it's replaceable. And so if anybody's thinking there's going to be like, a $20 or $30 spike, if this happens, that's not going to happen because the market already knows. I think we may see a $7 to $10 spike, but the market knows that OPEC definitely has a spare capacity to bring online if they need to, in case of.
Great. Okay. That answers a lot of my questions. So Michael, do you have any questions for Tracy about this?
Yeah. So, game theory. So if you think, if they do this, then then we do that, then we do that. Response, is like a chess game. What happens? I know that there's this spare capacity, but a lot of it has to come through the Persian Gulf, right? So what if Iran all of a sudden decides that everyone is their enemy, that Saudi Arabia let the Israelis fly through their airspace to attack carg or wherever they attack? Could, further disruptions, could Iran completely choke off the Strait of Hormuz? I mean, what do you think is the probability, likelihood of that?
I think theoretically, obviously they can. I think the chances of that are slim to none. What I think they would probably do in response is have their proxy groups in Yemen start bombing Aramco facilities again. I think they would do that over closing the Strait of Hormuz because they would be cutting off their own exports as well if they tried a complete blockade. And they have said they were going to do this many times in past history. They never have. And so what I would look is, I think that would be a last desperation measure. I think what you would see beforehand is you would see their proxy groups within these other countries start attacking oil facilities. Of course, you would see a ramp up in the Red Sea. You would see Yemen. I think they would use Yemen as the hub for that to start attacking everything again. That would be my first, like, I think that would be their go-to scenario. And then I think the Strait would be the last case scenario, in other words.
Sounds interesting. Okay, let's move on to LNG, Tracy. You posted some stuff about LNG. You've had some pretty bullish views on it, which is great as a strategic play. Given some of the supply chain disruptions that you've talked about, and you posted this week, do you still see LNG as a strong opportunity, or is that kind of done?
Which in the US, are we asking?
Sure, yeah. Your chart is looking at LNG projects and potential. You're quoting a Bloomberg story talking about threatening to extend global energy crisis. Right. So looking at the construction supply chains, expected supply, other things.
Yeah, I think in the near term, I think if you're, to be honest, I think if you're looking at 2025, I'm very bullish LNG. Beyond that, if we start looking at 2027, I think there's too many projects online. I think it totally is going to depend on who and what happens in the administration of the pauses that went for the export licenses that are on pause in the US. But I think after 2027, you'll probably see prices stabilize. But I'm really looking at, I think, over the next 12 to 18 months, is going to be really interesting as far as LNG and LNG prices. After that, I kind of see that coming, kind of stabilizing a bit in 2027, to be honest with you.
A lot of supply. So, okay, so if Kamala Harris is elected, do you believe she'll keep the export moratorium on? And if Trump is elected, will he lift it? I mean, is that kind of the basic expectation?
Yeah, I think that will happen. And in fact, I think that even, I think if Kamala is elected, I think that the oil lobby, and that includes like the API or whatever, would be almost too much for her to say no to. Let me put it that way. I think that she would be, I think they could walk over that administration much easier than they could walk over the Biden administration, in other words.
Okay, interesting. And so what would be their priorities?
As far as the Kamala, I don't know. Do you know? Well, she hasn't talked about anything.
No. What would the industry lobbies be wanting to change about Harris's view?
Well, if we're talking about the energy lobby, obviously that's going to be the first thing is the LNG export moratorium, right? These guys already spent a ton of money on these projects. They're on hold. Time is money, right? So that's going to be their first thing. And I think besides that, they probably won't care what that administration does or doesn't do, because I think their lawyers would go after anything she had to say and probably be more successful again than they have been with the Biden administration.
Why would they be more successful? I'm just curious.
Because she doesn't really, as far as I can tell, she doesn't really have a policy. And who is she going to have, who's she going to have in office? I mean, who's going to be her director at the DOE? Who's going to be, it's all going to be dependent on that. So I'm just projecting right now, just because of the way she's handling herself and not giving us very much information. But again, I need to see who she would appoint as a cabinet. If she has a very strong cabinet that would push back, sure. But, right now, she hasn't really given us any idea or a plan.
Could we have a less capable energy secretary than Granholm?
No. Well, never say no. Never. I'm not going to hate saying that. We probably would. Yeah.
So what would happen if Trump were elected in terms of policy? Do you think the
Lobby,
energy lobby would
you know,
kind of get what they want?
yeah, of course. I mean, the exports would be lifted immediately. I know he says drill, baby, drill, but technically, you can't force these guys to drill, baby, drill, and they're not going to because they want to keep their stockholders happy and they don't want to get into debt again. And so I wouldn't be as worried about his saying drill, baby, drill, and oil prices are going to immediately collapse because oil companies have already been down that road twice in a big way, and I don't think they're about to do it again because they don't have investors anymore.
Yep. Tracy, I've seen Trump say this a couple times, and I think about you every time he says it because I always want to ask you the question. He's said in rallies recently that he will lower your electricity bill by 50% within a year of taking office. Is that possible?
It is possible if he focuses on building out the grid system, building out natural gas facilities across the grid and for every utility company. I think that you absolutely can, and endorse nuclear to be integrated into the grid. So I think there's a lot of things that you could do because it's really about an aging grid and energy scarcity that we have right now with a growing demand for energy. So there are things he could do, particularly for utility companies, to make life easier for them so that they could reduce costs for their customers. But that's going to entail, we need more nat gas facilities.
Which we have a lot of, right? In fairness, we do have a lot.
We have a ton of nat gas. I mean,
Right.
we're so lucky and it's cheap. I mean, sometimes
Right.
negative.
Yep.
So we have a ton of nat gas. It's a great resource. We should use it. It's clean burning out of all the fossil fuels. You can streamline nuclear permitting, the nuclear permitting process, so there's not so much bureaucratic red tape. So it doesn't take 5 to 10 years to get a permit and another 5 to 10 years to build. We can streamline that. We had we had a company out today, Blue Energy, who's working on capability to use old shipyard plants to build their SMRs because these are modular reactors, and reduce the time from 10 years to 5 years and reduce the cost from 10,000 megawatts to 2,000 megawatts. So there's a lot of plans for this. So he can give those kind of companies money, federal funding to, fund those projects, fund that research. And so there's a lot of things that his administration could do, or any administration could do for that matter, to kind of move this process along quicker.
Okay. So, but could he do it within a year?
Well, no.
Okay.
But I mean, politicians lie, right? When they're campaigning, let's be honest.
So maybe
I shouldn't say they're lying. I'm not going to say they're lying. I would say, politicians like to
exaggerate.
Exaggerate. That's a great
exaggerate.
word.
Right. But I definitely think it's possible. I mean, politicians say what they think the constituents want to hear to get elected, right? And we all know that in reality that doesn't always happen. And that goes for any administration, not just Trump, not just Biden. I mean, go out throughout history. We've seen the same thing over and over again. But it's definitely possible to do, and there's a lot of ways that you can do that.
That's great, because I didn't think it was possible, even in like 2 years. So at least I'm hearing.
I think it's absolutely possible. Yeah.
Great. Okay, guys, thank you so much. This has been absolutely fantastic. I'm so lucky to have you guys on. Thank you so much. I really appreciate your time, and have a great day. Have a great weekend. Thanks, guys.
Bye. Thank you.
Thank you.